Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Bogumil Baranowski, author, podcast host, and the founder of Blue Infinitas Capital. Many people may know Bogumil for his excellent podcast, Talking Billions. However, as I turned the microphone around on Bogumil, I was interested in learning about his investment philosophy and approach. In this in-depth conversation, we covered the founding inspiration for Blue Infinitas Capital, what types of clients he hopes to attract to his new firm, the types of companies Bogumil gravitates toward, the value he derives from writing books, and how you invest if you have an infinite time horizon. And without any further ado, here's my conversation with Blue Infinitas Capital's Bogumil Baranowski. You recently started a new firm called Blue Infinitas Capital. I'd love to hear the inspiration for starting the firm.
Wow. Well, hi, hello, Ben. Nice to see you. It's a terrific question, and you're catching me at an interesting time because 3 months ago, I launched my new firm. So I've been in the business investing money for wealthy individuals for 20 some years now. I'm 43. And I think it was an interesting moment for me because I was thinking about the past 20 years and I was thinking about the next 20 years. And it was a lot of soul searching. And I was thinking, what's the environment? What's the setup that I would love to have for me and the clients I work with for the next 20 years? And obviously the idea probably has been with me for a long, long time. I mean, a lot of us have a dream of owning and running our own firm at some point. I think it's like this kid's dream. I want to own a railroad and I want to own a business at some point. I think that was my dream. And I owned a railroad stock at some point of my life. But there was this moment where I thought, I think this is my opportunity to launch my own firm. And I spent 20 years in the business, half of it, a little bit over half of it, rising within a firm that was growing from 3 billion in assets to I think 12 billion. And I was made partner within 2-3 years of joining, and I learned a lot, and we grew, expanded, added teams. There were a lot of fascinating characters at that firm, and I learned from them as well, decades of experience. And then I had this opportunity to co-found a firm 8 years ago with a few colleagues, and we had a lot of fun. It was a great experience for me to see a different aspect of the business world, where you go from a moment where they tell you, this is your desk, this is the phone, and you're an analyst now, to actually being responsible for running the P&L of an investment firm and making decisions about everything from what kind of furniture are we going to have for the clients to come in and sit in the hallway, in the waiting room, all the way to software and server choices and all the other things that you need to build a firm, compliance, trading, reporting, on and on and on. Fascinating journey where you realize there's so many other pieces that come to play. So launching my own firm, I bring to the table this kind of experience of both being an investor, managing money for other people, but also thinking of how does the investment business really work? What does it take? And then I'm sure we'll talk more about it, but what kind of clients would I like to have given the investment style that resonates with me? And all those pieces have to be aligned. And I think the word that will come up a lot, I think, in this conversation is the certain alignment. That I think it's the secret sauce to success in many pursuits, but I think especially in investing, where your investment style is in line with the clients that you have, and the business setup allows you to operate in a way that permits all of it to function. So that's how it all came about. 20 years into the business, thinking about the next 20 years. I'm looking at Buffett and Munger. Maybe I'm just getting started when I think of the runways that they've had, but that's where I am. I'm very excited about the next 20 years.
Well, congratulations on whatever, being self-reflective enough to think about what's the best situation for you to invest. I'm thinking, sorry, when I was thinking about the name, I'm curious
Uh-huh.
why you chose it and what
hmm
does it mean to you?
So a couple of pieces to it. Blue, the color blue. I fly planes and I sail. And to me, blue is the open horizon in front of me. I manage money for families, kind of open-ended opportunity. And it rhymes with the word infinite. I always mention how we operate with an infinite investment horizon. When you have family wealth, you're not really thinking in terms of a month or a quarter. You're building a vision for at least 100 years. And we'll talk about it more, but it's more of an exception than a rule that you have a family that has had wealth for more than a few generations. There are enough things that happen within and outside that can undermine that kind of path. So the infinite horizon. I like the word infinitas. It's a Latin word. And it's a dead language. So it's both a play on paying respect to the past, right? The wealth that I'm responsible for has a history. It came from somewhere. It's been around, in some cases, multiple generations. And then that infinite horizon ahead of us, the future. So it's a bridge in a sense. In this very moment, we're making some decisions that will have a huge impact on what will happen to that wealth over the next few generations. But we have to remember how this wealth was created, what it took for it to be even here today. And it's a certain heritage and a certain long-term way of thinking that allows me to do my actual stock picking and portfolio building around a much bigger framework. So that's the blue open-ended horizon, infinite way of looking at things, and then remembering that the past matters. So that's why the dead language Latin that I really like to bring up as well.
I like how much thought you put into that. And when I was developing the new microcap strategy that I'm running with my partner at Devonshire, I came up with what are basically 10 founding principles that we aim to live by. So much of it was informed by all of my experiences working for other firms. So as you were starting Blue Infinitas, were there specific foundational elements that you thought had to be included?
So it's a wide range from individual stock selection, because I build actual portfolios where I hold, 30, 50 stocks for clients, publicly traded, all the way to a big vision of what that portfolio can do, what it means. So giving that money meaning, right? So we'll talk more about the actual stock selection, but there are certain criteria that I look at: good business, good management, good prospects. We'll dive in more in a minute, I'm sure. And when I buy them, I like to say that I'm looking at them when they're down, cheap, out of favor. And I'm sure we'll talk more about it. And then there's a list of things that I avoid: mistakes, simply put, questionable management, too much debt, secular decline. These are the things I like to avoid. But the big framework for me is what kind of capital I'm responsible for. And I like to say that it's the money that my clients don't immediately need. And I think it's very important to know, when you take a long-term view and when you make investments, like I like to take, a 3, 5, or a long-term view for each individual investment, it has to be the money that they don't need for next year's home purchase or next year investment in their own operating business, or a shortage in working capital kind of situation where they need that capital quickly. None of that. It has to be capital that they don't immediately need. That allows me to operate with that kind of framework. But also the second thing, and I talked about the past, it's the capital that they can't afford to lose, cannot afford to lose. That wealth was created by them, by previous generations, whatever the context might be. They realize that it's a capital they cannot replace. Whatever the circumstances were that allowed them to create that fortune might be very hard to repeat. So it's the capital we cannot afford to lose. So between the two, having this open-ended opportunity and knowing that we cannot lose it creates a beautiful framework to operate all the way from an individual investment to a big portfolio vision to a whole family view of 100 years from now, where could we be and what kind of compounding we could achieve. It's a much more relaxed, patient way of looking at investing, because we can wait. We can wait to buy. We can wait for the ideas to work out. We can wait. And in the world we operate in, I think a lot of us just cannot wait. We don't have the time. When you think of a family fortune, they have the capital, they have the time, and the rate of return, it doesn't have to be very high. We're not trying to win any short-term race, but you have year after year of compounding. And you and I know very well what can happen if you have a long, long runway and a very respectable rate of return without massive drawdowns in between, an enjoyable journey, as I like to say, you can get pretty, pretty far.
And I love all that. When I had my friend Su Chen Tan on the podcast, he talked about, he told people that he was going to invest for 50 years, and a lot of people were like, "That's crazy! Like no one talks about that." And he's obviously attracted some really interesting LPs who really that concept of long-term compounding resonated with them. And so, like, the more I've studied successful investors, the more I believe that having the right LPs is a necessity, because you might have that framework and people might tell you they have that framework, and then March of 2020 happens, or March of 2009 happens, and people start to get nervous. So, like, what is the, like, I get that these are wealthy families, but they're people as well, right? There's someone's making decisions and the motions of the market. So how do you think about coaching them and making sure that they are the right kind of LP, that they do actually have that kind of long time horizon to be able to achieve the compounding you're discussing?
So there are a couple of things. First of all, if I may, I don't call my clients LPs. So they are long-term relationships, and the way I manage money, it's a registered investment advisor. So they have separately managed accounts, and I see them as someone that will be in my life for a long time, and hopefully as long as I'm around. So it's a long-term relationship. That's why with individual stocks and with the families, I take my time. I mean, even the last few weeks, I got to meet some new families that found out about me or got introduced to me. And I sat down with them since the beginning of the year multiple times. And it takes time to get to know each other. And some of those conversations will turn into admiration and friendship. And some of them will turn into clients that I think I can help. And I think listeners of my podcast know how I'm trying to be as generous as I can, giving up even 5-10 minutes of my time. Even today, early this morning, I took 2 calls from listeners where I think that time gives me a chance to get to know the people that are listening, reading what I write. But also I'm learning more about how certain things resonate with people. And out of this big, big pool, there's a handful of people in the last few weeks that I sat down with and had serious conversations if they could be clients. And I always tell them, let's pick it up next time. I want us to have multiple touch points, in a sense, for both of us to really see, think, and ponder if we're a good fit for each other. The reason I emphasize this is because time is very precious, but quality time spent with certain individuals that could be really clients, it's a time very well spent, because it will pay off as an incredible dividend over the next few decades. And you brought up some stressful moments. And in those moments, and March 2020 is still a very vivid memory, although it's been 4 years. I can't believe it's been 4 years. It feels like yesterday when you brought it up. In moments like this, you get those calls from clients, and you always will. You have to be ready for those calls, and they don't teach you at business school, but you will get those calls. And clients want to hear your voice. And I had clients call me and they said, "We just wanted to hear your voice. You're probably buying things. And just get back to it. We just wanted to hear your voice." Having that time with them and building that kind of equity and trust, it doesn't happen over one cold call. And it's not a cold call kind of environment that I operate in. It's more about getting to know each other. I meet their families. We have many conversations. And then when it really feels right, we both have this moment when we say, "I think this could work. Let's give it a chance." And then even past that point, there's a time when we really get to know each other. I think you brought it up, how a lot of people think long-term until the market sells off, and somehow we all become very short-term focused in those moments. But I like to say that when I onboard a new client, I really appreciate if we can go for a tough period together. I think we will learn more about each other. You will learn more about how I operate under pressure, and I will learn more about how they respond in moments like these than in any conversation, lunch, dinner that we had before. I think this is the true eye-opening moment. And usually I have a very, very good feeling of how things will play out. But I think it's still very beneficial for both of us. It's kind of like you're cementing something here, right? A long-term relationship where you realize This is the language I speak. This is how I operate. This is the kind of decision that I make. And Ben, one of my favorite moments is when the clients know what I'm about to do. When they say, "We know you're probably buying," like they already know, and it puts a smile on my face because they know me so well. At that point, they know what I will do, and I know them so well that I can almost finish their sentences. And that's the kind of relationships that I want to build. Not many, but deep and lasting. Because when you think about investing, and if you want to buy an investment and hold it over the long run and build an entire portfolio around that philosophy, you have to have on the other side of it relationships that will be with you through the easy and the hard. And if you see investing as a lifelong pursuit, spending 50 decades in this industry, let's say, you will have some times that are very trying. And when I say trying, you might have even a stock that hasn't moved for 2 years. To sit down with a client and explain why are we still holding it. And it's a conversation I had not long ago with somebody, and they know that I gave it a lot of thought. It's a very intentional decision that we're holding on to it. I see that there's a lot more on the table left for us to capture, and that's why we're holding it. You have to have a very solid relationship with your client, that they know what you're doing, they trust you in those moments. It's a very relationship driven business, and you earn something that's priceless, and you offer something that's priceless. I grew up in a household with two doctors. My parents were doctors and physicians helping people. And so medicine and all that was in the house, and we talked about it a lot. And for them, it was a calling, and I could tell it was a calling. In the investment profession, it's very similar, because when you look at a money manager, somebody you want to work with, you want somebody that's in it not just for the money. Like, imagine you want to get a knee surgery, and I'll tell you, Ben, go to the surgeon. You can tell it's just like, this is the best price to operation. No. They just you have to have it, right? Like the incentives are a little bit skewed. You don't want to have a surgeon like that. You want somebody that is just obsessed with that aspect of what they do. They've been to every conference, every event. They've read every study. They looked up all new ways of doing that kind of work, and you know that you're in good hands. But the last thing you want is somebody that actually cares. And it's a very intangible thing. It doesn't show up on the website. It doesn't show up on the balance sheet. It's not visible, but you feel that this particular individual is in it because they love it. They're in it not for the money. They just have to do it. It's their higher calling. But they actually care, and they want this surgery to go as well as possible. They care about you. They'll hold your hand. They'll remember your name. They know who you are. They know why you need it. And they'll be there when you wake up. It's such a powerful image in my head, but that's the money manager I want to have in my life. And if you surround yourself with an accountant like that, a lawyer like that, a money manager like that, a banker like that, a doctor like that, a dentist like that, a couple maybe more individuals. You might need a mechanic if you have an older car. You are in a really good place, right? You have people that you can lean on. And there's so many situations where I had a conversation with Christian Billinger, who manages his family money, on my show on Talking Billions, about it, how there's this pride in what you do, and the soul in the games, and feeling when you will do the right thing, even if nobody's looking. And in the money management business, you want to have an individual that you know for sure that they will do the right thing, even if you have no way of judging the decision. And it's an intangible thing. It's my aspiration. I have quite a few mentors in my life that have done it in their careers, and I aspire to have the career that like they have had, where my clients know that I care, and even if nobody's watching, I'm doing the right thing for them. I'm treating them the way I would treat my grandma.
I love that. I mean, you have thought so deeply about alignment and the not the monetary benefit of being an investor, but also um, the benefit that you can provide by giving these families, a good rate of return and some security, and the way you can change people's lives. And some people are really wealthy and some people are not that wealthy, and you can change people's lives over a generation. So, my guess is that people really, really, what's the right word? Really appreciate the degree to which you care about their well-being and their family's well-being. So I love all of that. And now I think would be a good segue to talk about the investing side and how
Mhm.
you achieve said goals. Um, so let's maybe just start with the style and philosophy, not to
Mhm.
put you in a box, but maybe just talk about your approach and how you select securities. And, you already mentioned Buffett and Munger, so I have a sense of who some of your, idols are in
Heroes.
terms of
Yeah.
investing in heroes, but just give us an overview for people who are curious about that.
So a bit of a backstory. So I was born in Poland. I went to schools around Europe, and I was an exchange student in Brussels. And your audience can look up a TED Talk. I share the story how I discovered investing. It was Peter Lynch's book, One Up on Wall Street. And I was in Brussels. It was an English language bookstore upstairs. I remember exactly where that book was. And I sat down on the floor. Some people might remember those days when you would go to a bookstore and you would sit on the floor with a couple of books and then decide which one goes home with you. And that book really spoke to me. So I studied at the time economics, accounting, finance, and some of the courses were very advanced. I think one of them was options pricing model. We were doing all kinds of very sophisticated things. But it was soon after the internet bubble burst. So a peculiar time to be interested in investing or finance. So you would go the more corporate route. Most people did at the time, as a consultant maybe. But I thought all of those pursuits were very limiting, just becoming an accountant or becoming a consultant. And I thought, how can I combine my curiosity in everything from history to business to economics to finance? And I like the language of accounting too. And understanding people, psychology, all of it in one place. And I picked up this book, One Up on Wall Street, and Peter Lynch says this very simple idea that stocks are small pieces of businesses. And then he shows, what are businesses? What's the purpose of a business? Which is not that obvious, and it's very misleading. When you look at the stock market, there are thousands of tickers out there. They're moving up and down, and I think a couple of my professors got really burnt in the internet bubble, and were really unkind in their descriptions of some of the companies of the era, including one. Well, if it's a case study, so I hope it's okay to bring up Amazon. But I remember one professor that explained to us why this is the worst business in the whole world. And maybe he's listening to this, so hello. And the timing was not, it was a very contrarian decision. And I think the contrarian bone was something that has helped me in the investment world quite a bit to go that route. But Peter Lynch's book spoke to me. He brought up Warren Buffett, who I had no idea who he was at the time. I thought he was just a CEO, like any other CEO of a major US company, but just what's so special. And then I read Buffett's forward to one of Ben Graham's books, Intelligent Investor, who was Warren Buffett's mentor back in the day. And I thought that the way he describes ownership of businesses just speaks to me on so many levels. There was this intellectual pursuit here of figuring out a certain puzzle, why the business works. And when I say works, it means it has a profit, which is not that easy in a very competitive world out there. You came up with something that people are willing to pay for. Somehow you figured out a way to have costs that are lower than that. And you found a way to make it available to many people. One times the other, and you have profits that could be in billions. Actually, a few days ago, I was looking at all the companies that have at least $1 billion in operating profit. And it's not a very long list, but it's quite an accomplishment to have $1 billion in profits, right? So my investment philosophy is basically business ownership. I see stocks, the portfolios that I hold, as ownership of businesses. The families I work with might have had one original business. In some cases, it might have been a long time ago. And that business was sold for various reasons. Industries don't last forever. The families might not be interested in running those businesses. There was a very interested buyer. Whatever the reason was, the business is no longer with the family in most of the cases. But they took the next step, which is going from creating wealth to keeping wealth, where they have a portfolio of businesses. Obviously, they could be private or public. In my world, they're public. And it's a collection of businesses where I see an opportunity to continue to compound the wealth that the family has. So the essence is ownership of businesses. But then what kind of businesses? And The businesses that I gravitate towards are good businesses. It means they have decent margins, decent returns. It's also important that the management that you have. I say that you buy a business, you get the management. When you really think about it, right? You buy the business, but it comes with the management, right? So the kind of investing that I do is public markets. So I don't go in and switch out the team that's running it. That's not even what I can provide. I don't have the names in my pocket to replenish all the CEOs in the companies that I own. So I get the management. And I'm very curious what kind of management it is. And you brought up the word aligned, and I think it's an essential word to this conversation, how you have to have a management that's aligned with the overarching vision that you have. If they're thinking long-term, if they're treating this business as a long-term success with long-term objectives, it's aligned with the kinds of investments I want to have. It's aligned with the family view of kind of infinite investment approach. It's harder and harder to find those businesses these days. I think there's a huge focus on very short-term results, and I'm sure we'll talk more about it, but that's a real challenge. And it's kind of a compromise. How far can you go? But the big thing about the management, I want them to underpromise and overdeliver. Like if it was one rule of thumb, I would love them to underpromise and overdeliver. I sat in meetings with so many managements over the last 2 decades, and within minutes, you can tell I'm dealing with a crew that will always underpromise but overdeliver. Not on purpose. They just know that the future is so uncertain that they have to prepare the business and themselves and me as a shareholder for all kinds of outcomes, right? So that's something that I value. The last piece, right? Good business, good management. Third piece is it's good prospects. The true value creation happens in the future. When you really think about it, any valuation models, I don't want to get too scientific about it, but the money will be made in the future. So I need a business that has an opportunity to grow. And one of the mental models that I like to use is, if you had to pick 20 stocks for 20 years, what would they be? And I ask that question to some audiences now and then. I get all kinds of answers to that question. But if you think about the next 2 decades, right, that the families I work with might be thinking in terms of 100 years, right? So in infinite horizon, finite assets, the businesses will come and go, flourish and fade. But what is it that they can do in the next 20 years? How can they impress me in the next 20 years? So I need this kind of an open-ended opportunity. And we probably dive in deeper into this topic down the road, but just real quick. I noticed that you can see at least 2 categories of businesses. I'm very US-centric with my investing, but it applies, I think, globally, that you have businesses that at some point will max out just in the domestic market for various reasons. The brand is only recognized in this country or in that country. Maybe it's driven by regulations. For example, they provide some services that, bookkeeping, tax returns, and it's only available really in one market, right? So they have a limited runway. That's something it's worth keeping in mind when you're thinking about the potential. It might be still a huge opportunity, but just keep that in mind. And then there's a whole category of businesses that they could go global. And you could see that brand at every single airport when you travel the world. You could see that on every corner in the tiniest little store. I think I can bring up Coca-Cola. I think, that's a success story of the past for many investors, including actually Warren Buffett that came up in our discussion here. But that's a brand you'll see everywhere, right? So at some point, years ago, let's say 40, 50 years ago, Coca-Cola was at this beginning of an incredible runway where an American brand was desired, wanted in so many markets, and they took advantage of it and they went global, right? So that's an ideal situation. And these days we have a lot of those opportunities in more asset-light, tech-driven companies that within a few years from their launch, they're available in 50 or 100 or 150 countries. That's unbelievable when you really think about it. Peter Lynch in his book has this story of a supermarket concept that worked in one part of the US, and then within a couple of years, it's coast to coast because they assume the market is similar, the consumer is different but alike, and you can roll it out coast to coast. But think of the recent companies that within a few years, they have customers that are global, right? The leverage that it can have. Like that's the kind of prospects that I'm looking for. That's the 20-year wait. It's worth waiting. I think they can provide. So you have good business, good management, good prospects. I think a lot of us can sit down and narrow down the list. I recently spoke with John Rotonti, who is quite a stock picker. I think just a very generous guy, brilliant mind. And the other half of what we talked about, which is very, very important to me, is not just finding the right business, but buying it at the right time. And I'm not talking about precise timing, right? We're not moon landing, landing on the moon, miles and miles away, thousands of miles away. But you have to take into account how much you pay for the business. I remember sitting in meetings and people were recommending stocks or presenting stocks. And one of the questions that I liked, and I have a couple of questions that I ask, first of all, I want to know what it is. I want to have a chance to really understand what kind of business I'm operating in. But the second big question for me is, why are we talking about it now? And I've been at conferences where people recommend stocks, and I always have mixed feelings about it because each stock belongs in some portfolios, it doesn't belong in the other one. So there's no medication that works for everybody. I think Tony Deedon, who invests money for families out of Zurich, has this saying when they ask him about the favorite stock. He says it's like asking a doctor, what's your favorite medication? And I don't know what you need. I need a little bit more background. But the big question is, why are we talking about it now? And to me, we all know that whichever business we pick, it's a good business, good management, good prospects. But I like to pick them up when they're down, cheap, and out of favor. It's kind of my mantra. When you look at any particular stock, and I think it's a fun exercise for anybody listening, you might have a stock that you really like. Pull up the chart and pull up a 52-week range. And I think a lot of people are surprised that even the stock that they think everybody knows about, everybody likes, everybody brought it up somewhere at a conference on Twitter or event, and everybody knows who owns it, they still have traded in a quite a wide range in the last 52 weeks. Now, if you have a longer term horizon and you look at the last 5 years, I think a lot of people are surprised that this stock was in a very wide range. And it's not all linear, that now it's at the top and then it was at the bottom. It's actually up and down for various reasons. I'm looking for a situation it's passing in nature, it's temporary, in the sense that this good quality business with great team and good prospects, for some reason, is out of favor with the public. And it could be a self-inflicted wound where the product launch didn't go as well as they thought. Maybe the guidance was off. Nowadays, the market can be very unforgiving, and it happens now and then. And you see a stock that it looks as good as it looked yesterday, but today it's down 10, 15%. But it could be down 30, 40, 50%. Don't be surprised that it does happen. And these are the moments where people get skittish, even about the best stock, best story out there. But I think that's where the opportunity appears, because you have a stock that's down, you have the valuations that got compressed. And I also like the element of the stock being to some extent out of favor, because when things start to work out, it's so much easier to impress the market if you're starting from a lower base. If you have a stock that's been performing very well and it's priced to perfection and everybody has a strong buy on it, it's very, very hard to impress. I think that gets lost. It's very tricky. Now, if you have the opposite, it's kind of like a good student that had a bad day. I think that's the best way to describe it. I'm looking for the very good students that had a bad day. And in the real world, people ignore it. So if you have a privately held business, it was a bad quarter, who cares? Like, the family will not sell out of the business because of a bad quarter. If you have a gas station that's hugely successful on the corner in your town, and just this quarter, I don't know, it snowed or it was too hot and the numbers are weaker, and if you had to report it to Wall Street, your stock would have been down. But it's a privately held business. Nobody cares. You hold on to it. You'll pass it on to your kids. The public market, the beauty of the stock market, we talked about Peter Lynch and the ability to participate in this ownership of businesses. It's such a remarkable invention on so many levels, with its drawdowns that you can take advantage of. But I'll come back to it in a second. But when you think about it throughout history, if you found a lucrative way to make money, and it happens today too, you will keep it to your family, you will keep it to your friends. Look at the whole world. And I get calls from listeners that tell me about all kinds of family businesses they own. They found a way to have that profit pool somewhere, and usually it's within the family. Now, the stock market is a unique invention. I had Guido Alfani on Talking Billions, and we talked about the history of the rich in Europe and how this moment of the invention of the joint stock company, where you basically had a lot of shareholders that were not your family and friends, they were strangers, open up the opportunity. We talked about women, how it opened up the opportunity for women to participate in the business success of those ventures. Now, a very important part to it, and probably a topic for a whole separate discussion, is that you as a shareholder, you have to be treated equally as the insiders, as the founders, right? And I think there are legal structures, there are disclosures, but I think it's part of elevated stock market culture that we have in the US and in a couple of markets out there in the world, where you can comfortably buy shares of a company and assume that you will be treated equally. As a minority shareholder, you would be treated equally as somebody that has control. So those couple of things that have to come to play. But the stock market, I said, the drawdown, I wanted to come back to it. You have this anonymous crowd that participates in the everyday activity. And that everyday activity is a bit of a distraction. But what happens is that if you're a patient, disciplined investor with a long-term view, you can buy those good quality businesses with the right management, with the right prospects at very low prices sometimes. Most of the time, I would imagine the market is fairly valued, maybe even overvalued as a whole. But you have those opportunities where the whole market sells off. It doesn't happen often enough. And I'm glad it doesn't, because it's a very emotionally disturbing experience every time. But it does happen to individual stocks. Even you and I talking today, if you pulled up a list of companies that have $1 billion or more in profits, operating profits, I'll show you a couple of names that you would think that have all the things we talked about, but their stocks are down 20, 30%. And it might be slim pickings, today, mid-2024, but there are times when that list is quite long. So you have a bit of time to go through those names and choose something that you like. Big picture idea, I have a list of companies I'd like to own at some point. Having done it for 20 years, I'm always open to adding new names to the list. So when people say, how do you follow so many names? It's not that I have to know everything about them every moment of the day. I've done the work, they made it to the list, and if they end up being down cheap out of favor, I'll take a second look and do a second deeper dive and understand what's happening right now. Are they worth owning? Right? So you have those moments of opportunity where you can zoom in. That happens in the public market. So for some people, it's disorienting and stressful and so on. But you can take advantage of those moments and see this as a buying opportunity to buy businesses, sometimes at 5 or 10-year low, only because they missed a few quarters, only because they had a delayed product launch, or there was something that's self-inflicted and passing. I do want to emphasize the things that I avoid, but I'll let you speak, and we can come back to it as well.
Oh, you said that you are even very US focused in your strategy. And I'm really curious, given that you're from Poland, you went to school in Europe, feels like you might have like a little bit of an edge and an understanding of that market. And people always talk about how cheap the European market is versus the US. Why is that not a bigger part of your portfolio?
It's a good question. I think there are a couple of layers to it. So I was born in Poland. I went to schools around Europe, and then I made New York my home. And that's where I spent most of my adult life. And I fully immersed myself in the US equity market. The market in Poland, when I was growing up, so the stock market reopened after 50 years of both communism and World War II. So it was a new experience. It was a tiny market. Actually, as a kid, I remember writing down the tickers. I had no idea what they are, but I was fascinated that the prices moved up and down. It was the major banks, insurance company. I think at some point there was a beer company. You've heard this story before in newer markets where there's just a handful of large companies. So I wasn't that interested in that stock market. I thought it was just too small, and it went through a massive bull market, a massive collapse, and a lot of excitement, just as any underdeveloped newer market. It's much more developed now. I mean, it's been a couple of decades since. Now, I spent a lot of time in Europe getting to know a lot of companies, and the ones that I gravitated towards had that open-ended opportunity that I talked about. And I sat down with some French managements and Swiss managements at times, and I would ask them a question that I like to ask, and it's a bit of a secret. I asked them, what are you the most excited about? Like which market, which product? And you'd be surprised how many times they told me the same answer. They said the US. So I'm sitting there with a French company. I'm not going to bring up the name. I saw the management many times over the years. And this company is a French company, but I think at the time had about 2-3% of operating profit in France. And they were very excited about the US, a couple of states specifically. And I was thinking, okay, I'm flying to Paris to meet this company that's managed out of Europe. And with, it's all flavor of, corporate culture. I think Europe is very different than the US, but I think it's a separate topic for another episode. And they are the most excited about the US market. And time after time, I realized that the companies that I gravitate towards, the ones that have a big open-ended opportunity, even if they happen to be headquartered in Europe, and I own some at different points in time, but they happen to be more global players that could really grow and become massive and compete really on the same level as US companies. I made my life easier, and over time, I would say that 95% of my attention these days is on the US market. It's such a big market. The size of it, the depth of it, the variety of it. And I think the US has this massive gravitational pull. It's a bit of a home bias in a way. I became American 8 years ago, but I felt like a New Yorker and American longer than that. Where I see how the US brings in so much talent. I know so many smart people that chose to give their skills and experience and wisdom back in the US market. And then you have successful companies that were even started in Europe, but then they got listed in the US. I can mention a name. It's no recommendation. Spotify, for example, right? Started in Europe, listed in the US. I think the official headquarters might be in the US as well. So I see how the US has this huge advantage in terms of both attracting business opportunities and an immense pool when it comes to talent coming in. And there are obviously a handful of big companies that have that kind of power as well outside of the US. But they're competing against some massive institutions that have, and when I say massive, they could be very big in their specific industries, right? I'm not talking only about the trillion-dollar companies, but if you want to be in this sector, this segment, this subsegment, you're contemplating, one or two options, and most of those options happen to be in the US. So the US has this massive growth opportunity in that sense, and that's my choice. I looked at other markets and other opportunities. And as you said, I lived in Europe for a long time. I say that I was born Polish, became European, only to choose to become American as an adult, kind of 3 different identities. But I think there's nothing like the US corporate culture and mindset and the ability to take risks, the ability to make mistakes. I think it all translates into something that you really need with business success. Some companies manage to replicate it to some extent in a couple of places outside of the US, but I think it's tricky and it's not the same. And when you look at the companies that created the most market cap value, just as a measure in the last decade, let's say, it's heavily US centric. And I'm just an observer here, right? I'm just observing the world. And I have to gravitate towards the places that have the biggest opportunity to create more wealth. So I'm thinking in terms of the next 20 years or next 100 years, what are the places that are at the cutting edge where I think the most of the new innovation will happen? And it's a handful of places, and the US is really up there. It's a unique setup, and it's not just one thing. You say, oh, the taxes or this or that. No, it's so many different elements that come together. And I think because I wasn't born in the US, I didn't even go to any American school. I got all my degrees in Europe. But watching the US from outside and coming to the US and fully immersing myself in this new culture and universe made me see things that other people see as a given, and realizing, no, this is very unique. And I'll just mention it briefly. Even the respect for property rights in the US, it's just unbelievable. And it's such a gift. It's almost like the air that you breathe. And I'll ask you, there's this joke about the two fish swimming, and one is asking the other one, how's the water? And the other one says, what's water? Like when you are in it so much, you might not even know. And so there are certain things that the US has, and respect for property rights is such a big thing that anywhere in the world you go out and you think you bought something, but you don't know if you actually own it. And it's such a powerful idea that in the US, there's this huge trust that you bought a share of Coca-Cola and you really, really own it. There's such a big, not just legal, but cultural background behind it that enforces the fact that you own it. I met families that are still collecting some royalties for oil royalties for assets that was in the family, that were in the family, 3-4 generations back. That's a very unique experience. That's in Europe, Europe being the other, big developed continent, with the conflicts that happened and the shifts and the political change and so on. And Poland went through so much change in the last 100 years alone. So I have a lot of experience knowing that wealth can be created, but it can also be taken away, not just spent or wasted away by the family, but also can be actually, confiscated, lost, burnt, and taxed away. To have a system where you can perpetuate wealth over the long run, whatever you choose to do with it, but you do have that kind of open-ended opportunity, it's very unique. And when you're thinking about managing a family fortune, if I had to choose, and I wrote Money Life Family that I know you read, and I made a big case for the US. If I had to choose one place, and you told me there's only one place where you can put all your assets, there's only one country I can think of that's big enough, deep enough, diverse enough, has the structures that I trust, and an environment that provides the opportunity for growth. There's only one place that I can think of. I know that there are smaller countries that may be ranked higher in terms of some, ease of opening a business. I don't know. I mean, I think Singapore ranks very, very high, but I'm talking about size, right? The US is really unique, and Europe is a collection of countries. It's not one country. It's a collection of countries, and I think we get reminded of it quite often. We say the EU, the US. The EU is not in one place. Like if you actually go to Europe, drive around. First of all, there's so many different languages, and within countries, there are regions. And you drive through Germany and you hear the language in so many different versions. And Spain, the same thing, right? So it's a very fragmented continent, a beautiful continent with amazing coffee and good food and incredible museums and a lot of different things. I think it's fun to visit. And there are quite a few companies that succeeded on a global scale, but there are not that many. But if you had to tie my hands and say, pick one place, then it's the US.
It's hard to argue with success. It'd be an interesting, it'd be interesting to see if we continue in the US to compound at the same rate, or whether there's some room for disruption coming from other places. We'll see about that. So, now that we have a really detailed framework for your approach, I think it'd be great to hear about a past position that you think represents the quintessential Blue Infinitas stock.
So it's not a recommendation. It's an old case study, but I think it summarizes quite a bit of what we talked about. And if I had to pick one, that one came to mind when you asked me. So years ago, I owned Green Mountain Coffee, and Green Mountain Coffee makes coffee makers, but they make money on the capsules. And it's still publicly traded, part of another company. Not a recommendation anyways. But back in the day, I met this small company. It was a smaller company at a couple of conferences. And I found it really fascinating because they had this model where they basically were giving out the coffee makers at good cost and making all the money on the capsules. And then they did the second thing. And the second thing that I found interesting that's different in those kinds of models, razor blade models, where they open up the platform to other brands. So they started selling coffee and other beverages from other brands. So they partnered up with other brands, and they took advantage of those companies and their brand equity, which was really smart. So they opened up the platform. And then they had quite a bit of success. So I watched them, and it was an expensive stock, a fascinating story. And I put it down on that list that I told you about. One of the businesses I'd like to own. And I sat down with the CEO and the CFO at one conference, another conference, and I thought, they're really thinking long term. And then they ran into a hiccup. I was actually driving, and I remember this moment. And on the radio, there was a radio still. People were listening to radios at the time. At least I was. They said that Green Mountain Coffee has to recall the coffee maker because the water spilled, hot water spilled, and caused an accident. So I thought, there's something happening, and I don't know how bad it is, but they have my attention. And I already knew that it was a good business. I liked the management. I thought they had plenty of room to grow, US market mostly at that time. And I got to the office and I started looking up, and in the next few weeks, they told us a bit more. If you look up the history, if anybody has the history of the stock actually didn't go down that much at that time. Started to come down. But what followed was a massive correction in the stock. I don't remember if it was down 50 or 60 or 70%, but a lot. It just collapsed. The reason it collapsed was because they had to bring back from the shelves one of the newer models, maybe it was the newest model of the coffee maker they rolled out. Huge deal. So once you pull back all the coffee makers from the shelves, then the sales of the capsules where the profits are collapsed. Profits were gone. There were a couple of quarters with losses. But then I started reading more and more and more about it, and then they had conference calls and press releases. And there was this one moment when this is the call that you have to make. Is this a permanent damage, or is it a temporary passing issue? And I think it's the hardest decision you have to make when you're making an investment, especially when you're looking at stocks the way I do, where I want to be a value buyer, growth holder. I want to get a deal. So here I was thinking I might potentially be getting a deal. But the sweetener here was that they were able to fix one little piece in that coffee maker and ship it back. And I thought, okay, so the cost, it's not a total write-off, as in that you have to get rid of those coffee makers. They'll be back on the shelves, but there's a delay. And the delay was a couple of quarters. Very painful for a growth company to show a couple of quarters of declining revenues. If you don't understand the nature of that decline, it's very scary. But I knew there would be a moment where those coffee makers will be back on the shelves. So I thought, this looks like it's a passing issue. I don't think it's a permanent damage to the brand and the ecosystem that they created. It's just a delay in what can happen. And they have a way to figure it out. And as a long-term investor, I can wait. And I really thought that this will be a stock that I might hold for a while so that it comes back to where it was, value buyer, I'm getting a deal, and I could be a growth holder. This could be a multiple of what it was. I thought there's still a lot of room to grow. My ownership got interrupted. You know why? It happens now and then that you're not the only one looking at the stock. So I bought it, we held it. Case study, there are others that didn't work out. This one worked out, but it was acquired by a big player at the time with a massive premium. I don't remember the premium, but I thought it was like 70, 80%. It was a massive premium, right? Yep. Was it 90%? I don't remember. I would have to.
It was a big one.
It was a massive premium. So I had this short-term gain, which not all of my clients are happy about. We usually focus on long-term gains with a lower tax burden, at least in the US. And here we were holding a stock that I was really excited to not just buy, but think of it, wow, I've known them for a few years. I waited to buy, and I'll hold it for a short period of time. So that happens, that somebody else likes it even more than you do and can drop the capital and buy the whole thing. So they bought it. I haven't followed it too closely since, but it was a unique moment where I could find something that had incredible prospects, proven model, has been public for a bit, but it was too expensive until something happened. And this was a drastic situation, right? Not all of them are like that, but it was a drastic situation that offered an incredible buying opportunity at very low multiples if you normalize the earnings. And then you had this potentially incredible runway. So that's one of the ideas. And then, over the years, it's a range of ideas where it's a less of a drop, and still the idea is to hold it over the long run. Munger brings it up, and I think it's worth bringing up here, how when you own a stock over the long run, the return on the capital that the company can produce is a good indicator of how much money you're going to make on that investment, right? So I think it's helpful for me to buy something because it's down and cheap and out of favor. The reason why I like it is I like to think that I want to be the least wrong. If I get something that's already discounted, I need a lot less to be right. That's how I look at it. My margin of safety expands because I'm getting a deal. If I'm buying something that's priced to perfection, it's a whole different proposition, and I'm not that comfortable with it, right? At the other end of the range. The lower the price, the less I have to be really, really right. And I want to emphasize, and it may come up in your follow-up question, but I like to do things gradually unless I can't, right? So I like to buy gradually and I like to sell gradually. And obviously there are moments like March 2020 when I was getting calls from clients and I was buying hand over fist different kinds of stocks, and they were available at 5, 10, 20-year lows in some cases, companies that I've known for many years. And actually some of the companies that I just saw 3 months early at a conference, and they had a picture perfect story to tell. And then COVID happened and they just had no idea how bad things are or will be. And the market was very unforgiving. And for some of those stocks, it was a massive correction. So for those 5 minutes, I think that period will be talked about, discussed, and analyzed over the next few decades. I think we'll look back at that period. But that was unique. There are one-off company after company situations where you can buy and collect a whole portfolio of businesses that you can buy that are quality, but you paid the right price and it just makes sense to hold them.
I always like to ask people who say things that you do, we invest in good businesses that are getting more valuable and they've got a long runway. And the question is always like, well, why would that ever be cheap? I think that Green Mountain's a really good example of, they're the vicissitudes of the market and the end markets, and things happen to every stocks have their own little mini recessions. That was a big one relative to other ones, but it goes to show that if you're patient enough and you have that list of the business you want to buy, and maybe 1 or 2 a year drop into the wow, this is really interesting. We can't leave this without talking about your writing. So you're the author of several books. I'm curious mostly about how writing informs your investing. I find that writing my own thoughts and philosophies and ideas is really helpful to clarifying my own thoughts. And you almost have like little insights as you put it on paper versus just kind of swirling around in your head or talking about it. So I'm curious about how it helps you or informs your investing.
So it's interesting because my life has kind of a couple of pieces to it, right? I am a professional investor, and then let's put it as one bucket that I manage now in an investment firm as well. But then I write and I have a podcast, and I think all three pieces happily coexist. And I'll tell you how. I might have a very deep, very thoughtful conversation with a client, and I walk away with something that I'll be thinking about for the next week or two. And then I write it down, and it turns into an article, which invites some response from people, which sheds a different light on something that I was thinking about. And then I can bring it back to a podcast conversation and then have a fun discussion with somebody that might have been closer to this aspect of family wealth or investing or thinking about risk or thinking about some sort of a challenge. So I think the three kind of create this beautiful circular flow where the podcasts inspires something that inspires something else that inspires something else. And it starts, the beginnings of those flows are fascinating, and they're very serendipitous in many ways that allows my brain, my mind to stay very open. I feel like the secret to investing is to always be learning and always be reading and always be questioning. I was talking to somebody, we were talking about a investment process, and I said how I want to talk myself out of an idea. I came across something and I'm finding a way to talk myself out of it. And it's very positive because at the end of the day, I find something that I already tested in so many ways. I have less to worry that I didn't think about. And the market will surprise you and the stock will surprise you. There will be new things. I mean, who would have thought that Green Mountain Coffee will have such a massive product recall? I mean, it's one for the books. But those things happen. And that's, it's an extreme example. But my writing allows me to organize my thoughts. I think there's this idea, people that get into investing, if you took the time and you wrote down the investment case that you think you have, like in your head, oh, I'm buying it for those 3 reasons, but actually write it down and see it, and then add some more bullet points to those bullet points. Then ask some good questions that we talked about. For me, those questions are, what is it? Like if you and I are talking and then you bring up an idea, I've never heard of it. I don't know what it is. And you have to spend the next minute or two explaining what it is. And, you say, I mean, these widgets, those widgets, it doesn't tell me anything. What does Starbucks do? They serve coffee. It's like, how you explain to somebody why people go in and spend money for a cup of coffee that's priced very high. And you grab it and you run and you accept the whole experience, right? Like you have to explain, what is it? What do they actually sell? Coca-Cola says that they sell happiness, right? Like, what is it that they actually do? How they can accomplish something that's so hard and have a profit at the end of the day? And then why now? Why down? And I like the question, why up? What's the upside? How can it really? If you have a chance to write it down, so that's why writing is very important. And I've been writing, all my life, but publishing the last, I would say about 10, 12 years or so. And I think publishing in any form, even if it's an article or a newsletter, it's a fun experience because you write it no longer just for yourself. And I like this idea of when you write something, think of it this way, and at least I do, that you will not be in the room when it's being read. And it's a very powerful idea in my head because I have to write it in a way that will fall the closest to what I wanted to accomplish with that article. And I won't be in the room for you to tell me how you read it. I won't be in the room. I mean, I have those beautiful moments. I told you I'm trying to be very generous with my audience, and I spend 5-10 minutes. Even earlier today, I spent some time with some of my listeners who wrote me beautiful emails, and I just want to see who is on the other side and how what I'm doing resonates. But most of the time, I'm not in the room when most of the readers or listeners are listening or reading, right? So think of it this way. How can you write it in a way that falls the closest to what you're trying to accomplish without you being in the room to correct it in any way? And the reason why it's so powerful to me, and maybe, I might get a bit emotional about it, but when I work with clients and we have conversations about inherited wealth, and I knew the parents and the grandparents, and I'm working with the kids who are adults in many cases, and we have those very, thoughtful conversations, and I want to bring it back home in those moments. And I say, what do you think the intention was of the father, grandfather, grandmother that are no longer with us? When you think about inherited wealth, the person that you need the most is usually the person that's no longer there to guide you. And you need trusted advisors to be that kind of bridge that will pass on the intention behind it. And it kind of writing is the same way. How can we make sure that that intention remains very clear sometimes when we're not in the room? But yeah, writing has been a wonderful experience for me, organizing my thoughts. I think it elevates my investment process, and just going back and rereading things that I thought I knew at the time. It's been very helpful and humbling in many ways, right? Investing, it's not all huge success stories. There are quite a few situations when things didn't work out, and giving it some thought and learning from it as well. But between the podcast and writing and investing, I feel like I have this never-ending flow of inspiration and ideas that made me think about things that, in a way, that I think I would have missed out on if I wasn't doing all three. So I can't choose. I want to do all three as much as I can.
I'm with you on that. I mean, I see as being successful as an investor as a holistic process. And some people would say you should just spend all your time reading K's and Q's and just buried in financials. But I don't think that helps you. I think you should also you be talking to people. You should be writing. I've been very fortunate to be able to guest lecture consistently at a couple schools here in Southern California. And I think teaching, it's like trying to teach college students. It makes you really refine your own thinking and your own communication skills. And then writing is obviously very, very like important as well to me. And it's like it's hard to tangibly say this is why this is how it's like made me a better investor, right? Like these are like this X% return, right? Doing all these things once, it comes, like doing all these things at once gives me, better 20 basis points better return. But I think it's just, if you just think about, building a skill set that is holistic and robust, right? I think you have to do, it behooves you to do a lot of different things, kind of like not to make us sound too important, but like a Renaissance man kind of strategy where you're trying to do a lot of different things.
Very much so. I mean, if there's one secret, you have to keep on learning. The businesses that we had, 20 years ago, even if you look at the top S&P 500 names, a lot of them are no longer in the top. You have to keep on learning. And Buffett and Munger have been really remarkable. When you think about that, the same two individuals, well, Buffett especially, owned some cigar butt companies like the textile mill and even worse before, all the way to owning, a tech giant of today. It's a wide range of businesses in industries that didn't even exist at the time when he got started. Like it's just remarkable how much you have to learn and keep up with. And I think it's a real challenge for some investors that they get very comfortable with a select group of industries and they might not be open to what else is possible. And I think by definition, the biggest wealth creation will be in industries that you and I are not even aware of today.
Sure.
Right?
Sure.
And we have to keep up with it. We have to ask questions. It doesn't mean we have to be experts in the sense that I can build it myself. No, but I have to understand, how does the business work? How come they have a profit? They have something unique and special. They don't have to be keeping their goods on the shelves. It could be a service that's paid per month and the clients for some reason cannot live without it. I'm intrigued already. You see, like that's something that's, I think it's part of the learning process.
Well, Bogumil, this has been incredible. We could do this all day long, but we have to close with our favorite question, the one we ask all our manager guests. What do you think is the most underappreciated aspect of the investment opportunity in front of your new firm, Blue Infinitas, today?
Like the immediate thought that I had is that we can wait. The biggest power that family wealth has and the families that I work with is that they can wait. I think the whole world being so much in a rush, looking for immediate feedback and instant gratification. When you think of family capital, it's already substantial and it has the time. And that creates what we talked about, the opportunity to buy quality businesses when the time is right, when the price is attractive. But the second part to it, where the real value creation happens, is that they can wait for those companies to become the 10x, the 50x, the 100x. Not all of them will, no question about it. Some of them will be a waste of time, that's for sure. But to have that kind of mindset in a world where everybody is measuring performance month to month, and there are so many that cannot hold their investors for longer than a quarter or two, it creates a massive opportunity. So when you think of the investment world as being hugely competitive, if you have a 3-year horizon, there are fewer people in the room. If you have a 5-year horizon, even less. But if you can think in terms of a decade or 20 years, truly think of it this way and not be, heavily judged in between. There will be questions and I appreciate the questions, but you're not heavily judged, month to month. you have this opportunity that is available to very, very few people. And when you think of, true wealth creation, that's when it happens. Chris Mayer, who was on the show, talks about the 100x talks, and Phelps wrote a study about it. Those things don't happen in 6 months. Those things take years, and these are tough years. Sometimes it's dead money for a long time, but you can have that kind of open-ended investment horizon. And I want to end on a very upbeat note, and I think it came up in this conversation a lot. I'm very optimistic about the future. I think that there will be a massive new business creation ahead of us. And I think the last few years behind us, we talked about March 2020 and the pandemic. It was a time of stress and friction, not just for individuals, humans, but also for businesses. And the kinds of businesses that got started that I'm a bit aware of that are not even public yet, I'm very excited where they could be, 3, 4, 5 years down the road, once they're listed, once they're available to more of us, and what kind of runways that they will have. And the odds are that they will be companies that can go global and can be present in all the markets within a few years. And I think that the opportunity will be there. I think of Buffett, and that's the last thought I have for you today. It's not just that they picked the right businesses, but that those businesses were available for them to pick. I think that second half doesn't get enough attention. The fact that they operated in a universe where those businesses were even available for them to own, to buy. So I'm thinking the setup that we have, let's say that you open it up not just to US market, and let's say you invite the developed market and maybe a handful of other markets. Even if you limit to yourself to the US, I think you'll be just fine. But of all the businesses that will get listed in the next 5-10 years, I'm very, very eager to get to know them. And I have the patience and the infinite horizon that I operate with to buy them and see them flourish. I'm very excited about it. And the last few years that might have been very stressful for a lot of people, think of the change in how we do business, how we get education, how we get entertainment. There has been a massive shift that created quite a few opportunities. And I'm ready to see them all and be a part of them all. As Peter Lynch said, small stocks are small pieces of businesses. I think there will be a lot of them for us to own. So I'm very excited about it.
Bogumil, thank you for the ending on an optimistic note. We wish you luck in your new venture, and we'd love to do this again sometime. Thank you so much for being on Compounders.
Oh, it's my pleasure. Thank you so much, Ben.
Bogumil mentioned a number of securities on this podcast. I do not own any of them.